By show of hands, how many of you would like to make a few hundred or even a couple extra $1,000 a month without working a minute or getting out of bed? Well, as a college student myself, I invest my money and I'm able to pay a large portion of my rent just by investing and not even touching my original capital. Having a diverse knowledge of securities is a very important skill for anyone, regardless of their career path, to invest intelligently and to increase their wealth. I'm currently an accounting and finance double major with a very strong interest in a career in finance. I am a member of Scarlet Capital Management and Little Investment Bankers of Rutgers. I also have invested on my own since high school. Today I'm going to talk about the safest investments, bonds, the high-risk, high-reward stock market, and my personal favorite, ETFs. Bonds are a very important investment tool for investing. According to WellsFargo.com, when you buy a bond, you're lending money to the bond's issuer, who promises to pay you back that principal when the loan is due. In the meantime, the issuer promises to pay you interest or coupon payments to compensate you for the use of your money. So you receive your capital back plus interest for every year that your bond is that you're holding the bond. Bonds have an inverse relationship with interest rates. This means that as interest rates go up, the value of your bond goes down, and vice versa. To illustrate this, if you were to buy a 7% bond for $1,000, and then interest rates went up to 8%, no one would want to buy your 7% bond because they could buy an 8% bond out on the market. So now the value of your bond would decrease to $875 instead of $1,000. This isn't the worst thing because as long as you hold the bond for at least 2 years, you still make a profit with the $70 a year interest though. Bonds are an important investment because they allow you to diversify your portfolio with safe, low-risk investments. Fidelity.com recommends that 50% of a conservative approach be with bonds, as you can see here. And as it gets more aggressive, you want to hold less bonds. This is because bonds are safer and you won't lose as much money with bonds. But as you can also see, the high for bonds isn't as high as it is for the more aggressive approach. So now that you know how to make your portfolio safe, let me tell you how to lose a whole bunch of money with stocks. Just kidding, but stocks are a very high-risk investment. Stocks are the most commonly traded securities. According to Investopedia.com, a stock is a type of security that signifies ownership in a corporation and represents a claim on part of that company's assets. So as the company does well, your stock does well. And as the company does bad, your stock will do bad. So the trick to succeed with stocks is to find undervalued companies. You want to find companies that will do well in the future, that aren't necessarily doing well presently, because once a company is already doing very well, the stock price will already be adjusted for that. So you want to invest when the price is low and sell when the price is high. The only problem is it's not always the easiest thing to tell when the stock is at its low or at its high. Stocks are very high risk, but they're also very high reward. If you were to buy a share of Apple on January 2009, you could have bought a share for $78. And you could have sold that same share September 2012 for $705. This is over a 900% profit. On the flip side, if you jumped on the bandwagon at the wrong time and invested at $705, you would have seen the stock price fall to what it is presently at around $430. If you remember one thing from this presentation, please remember to diversify your stock portfolio. You don't want to put all your eggs in one basket. Diversification reduces risk because you don't bank on one company. If one company does bad and you're diversified, you won't necessarily lose a whole bunch of money because the other stocks in your portfolio will be there to bring it up. You can diversify with different companies, companies in different markets. You can diversify with different countries. U.S. and foreign stocks is a great example and is important because U.S. market as a whole goes up and down pretty much together. So there'll always be rough times. But if you invest in other countries as well, you may never have 100% rough times. But because the selection of stocks can be so risky, my personal favorite investment is ETFs. InvestorPD.com says ETFs, or exchange-traded funds, are a security that tracks an index, commodity, or a basket of assets, like a stock, but trades like a stock in the exchange. So they experience price changes throughout the day as they're bought and sold. SeekingAlpha.com states that no matter how good an investor you are, the average investor cannot beat the market. So one strategy is to invest in the market. Here's an example here of an ETF that tracks the S&P 500, which is one of the major stock indexes. As the overall market goes up, your stock will do well, and as it does bad, your stock will go down. It's a very simple and surprisingly effective way to invest for unexperienced investors. ETFs also allow you to play specific markets or commodities. This allows you to be speculative. For instance, if you think that there'll be inflation in the near future, you could buy a gold ETF, and it's a very good alternative to buying a whole bunch of gold and holding it in your home. You can also buy a real estate ETF, for instance, if you think real estate will go up. That's something that I invested in when the housing market burst, and it's done quite well since then. So I hope this has made sense to you guys and that you've learned a lot. We've talked about the benefits and risks of bonds, stocks, and ETFs. As the great Warren Buffett once said, rule number 1, never lose money. And rule number 2, don't forget rule number 1. He also said, never invest in a business you don't understand. There's no guarantees in the stock market, so the best way not to lose is to invest cautiously, smartly, and to diversify your portfolio.
Yay!